All right, so we have impairment of assets, impairment of an asset. When we talk about impairment, we are saying that an asset must be carried in the financial statement at an amount that should not be more than what we can obtain from that asset. It shouldn't be more than what we can obtain from that asset. That is to say that if you have an asset, for example, PPE, in your financial statement or in your statement of financial position or in your books as 5,000 Ghana cedis. And these assets, what you can derive from these assets, either through use or sale, anytime the carrying amount is more than the higher of these two values. Fair value less cost to sell, and what? Value in use. So when we talk of impairment, it is the amount at which the carrying amount, which is CA, chartered accountant, is greater than the recoverable amount. When we say a recoverable amount, it is what? As I started, the amount or the value that you derive from that asset from it what? Use or what? Sale. So the moment you select or you choose the higher of the fair value, less cost to sell, and value in use, all these amounts, the higher of this is represented by what? The recoverable amount. So anytime the carrying amount is more than the recoverable amount is what we call impairment. So what is impairment? An impairment is the amount at which the recoverable amount of an asset is less than what? The carrying amount. When the recoverable amount is less than the carrying amount. That is all about what? Impairment. And any asset should not be carried more than what? Its recoverable amount. And we said that the recoverable amount, RA, recoverable amount is equal to the higher of 1, fair value less cost to sell. Then 2, value in use. Please take note. Please take note. Under normal circumstance, for most, or I may not say all, most, about 99% of impairment questions, the value in use is always what? Higher than the fair value less cost to sell. Because every entity is run by rational human beings. So that If they can sell the asset and make more money and buy a different one, then they will prefer to sell it than to use the one that they are using, except for the fact that maybe that asset is more sophisticated and it is not common. It is not common. So in any case, wherever you see an impairment question that the recoverable, the value in use is given to you in the question, and the fair value less cost to sell, maybe they have given you some leading statements in order to calculate. Please don't waste your time. Don't waste your time. Just choose the value in use given and move away. You'll be correct. Because in most cases, the value in use is always higher than the fair value less cost to sell. What is the when we talk of value in use, what is the value in use? You know that when you are using an asset, you are not using it for a sale in an ordinary course of business. You are using it to derive economic benefit. You are deriving economic benefit from the asset. So what the asset can give you through its continued use is what we call value in use. Value in use. For instance, I am using an equipment, plant and equipment that will generate 4,000 units each year. And these units could be sold at a price of what? 10 cedis. So what will be the cash flow? The cash flow or the sales value, which will be the cash flow, will be what? 4,000 times what? 10, which will give us what? 40,000, if I'm correct. So this 40,000 is what you can derive from this what? Assets annually. So when the question gives you in annual in the future, then you need to discount this amount to what? To present value. To present value. I know Sir Stephen has taken you through IFRS 17, that is PPE. Under IAS, that is IAS what? 16. Virtually everything is what? The same. Everything there is what? The same. Okay, so now let's come to the coverage. When we say the coverage, we are talking about the scope. Which asset does this standard apply? It applies to all assets with the exception of the following. What you can see on the board. Impairment. Inventories, IAS 2. The standard that was just tested in the March date. Those who wrote the financial reporting knows what I'm talking about. IAS 2, inventories. We said that inventories are valued at lower of cost and net realizable value. So at any given point in time, you always choose what? The lower value. So after upon choosing that figure, it is already what? That impairment has already been taken care of. If the cost of the asset is 2,000, and then the net realizable value is 1,000, automatically you are going to pick what? The 1,000. So already the assets, the impairment has already what? By picking the lower amount, the impairment has already taken over. So impairment does not apply to IAS what? 2. Construction contract under what? IFRS 15. IFRS 15. The IFRS 15, we said revenue from what? Contracts. It is not applicable to IFRS 15. It's also not applicable to IAS 12. That is income tax under deferred tax. Income tax under deferred tax. Those who wrote the corporate reporting just ended that they came across IAS 12 in there. Then we'll talk about another standard called IAS 19. This is a level 3 standard, employment benefits. Another one is IFRS 9, financial instruments. That one is both level 2 and level 3 standard. Take care of the 1, 2, 3, 4, 5, 6. The sixth one. The sixth one, we are saying that investment property that is measured at fair value. Under investment property, we have two methods. Either the entity will adopt the cost model or the fair value model. So the fair value model is not, impairment does not apply. You should know the difference between the fair value model and then the cost model. Under the fair value model, we don't do what? We don't depreciate the assets, and all gain and losses as a result of this fair value gain or losses are recognized directly in P&L, unlike the IAS 16 or the IPSAS 17 that you do. All gain and losses will be recognized in other comprehensive income. And then the last one we'll talk about is IFRS 5, non-assets, non-current assets held for sale and discontinued operation. So these are the standards that does not apply to that impairment does not what cover. Please take note of the following. Note. Be careful under impairment. Be careful of amount in brackets. Be careful of what? Amount in brackets. When the question says that the fair value less cost to sell is what? 40,000. And then they said fair value less cost to sell, let's say 4,000. And the 4,000 is in the bracket. Please, where the amount of fair value less cost to sell is in the bracket, please, the assumption is that 4,000 had already been what? Taken care of. We said that it will be what? Fair value less cost to sell. So if we can sell this asset at 4,000 or 40,000, but there will be a direct cost of what? 10,000 in order to realize this sale, then we said that the fair value less cost to sell is equal to what? 30,000. So if the question says that the less cost to sell and it is put in a bracket, please remain the amount without what? Deducting the amount in the bracket. I repeat, be careful of amount in bracket. If the amount is put in bracket, it means that that amount had already been what? Deducted. If it is not in the bracket, please kindly go ahead and deduct it from the fair value. The second one I will state is 2, discount rate. Discount rate. For the purposes of estimating the value in use of an asset, you may be given a cash flow. a cash flow that when the asset is being used, it will generate an amount of what? 50,000 per annum for the next 5 years, for the next 6 years, for the next so and so. When that happens, you need to discount those future values to what? To present value using the present value formula. Present value is equal to future value 1 over 1 plus r raised to the power what?
N.
Raised to the power n. Raised to the power n. Raised to the power n. Raised to the power n. Raised to the power n. This thing can still be rewritten as, we have learned some topics in SHS, or yes, those who attended the international schools. I know you might have learned them in the your primary schools. Powers of numbers. Powers of what? Numbers. Powers of numbers. Or you might have also come across indices. Indices. The law of indices. The law of indices. So I was saying that this fair value, future value will be equal to present value will be equal to the future value. We'll be multiplying 1 over 1 plus r raised to the power n. This thing can still be rewrite. We can rewrite it as 1 plus r raised to the power negative what? N. Future value multiplying this. Now, the discount rate to use, we always use what? The pre-tax discount rate. Please never use post-tax discount rate. Always use what? The pre-tax discount rate. Where the pre-tax discount rate is not given, then you can assume what? Yes, who can help us? Incremental borrowing rate of the entity. Any of them would work. Please, any of them would work. When we are talking about cash flow, we are talking about proper cash flow. Issues like non-cash flow items, such as depreciations. Depreciation. Assuming the question says that the cash flow were considered after deducting a depreciation of 2,000 per annum, what do you have to do? You have to add back the depreciation, because the depreciation is not a cash flow what? Item. A cash flow what? Item. So the question can give you all sorts of things, so that you should deduce what? The cash flow from that question. And in the same way, they can give you the production unit for these assets. Production units. Then they say year 1, 4,000. Year 2, 6,000. Year 3, 4,000. Then they will give you, they can give you the sales price. So sales price, let's say 10. Then they will give you, let's say some direct costs. They can give you labor costs per unit. 2, material. 4. Then, under this circumstance, the net cash flow will be what? This that will be 4. So it is this 4 that is the what? The net sales price that you are going to use to multiply the what? The production units in order to get the cash flows. Another one is that in impairment, whenever you are estimating what? Cash flow, please, all cash flow must be restricted to what? Only what? 5 years. It shouldn't be more than 5 years. So in a situation where the question give you, the question come with what? A cash flow. We are in 2025, and they say that the asset will be able to generate a cash flow of 4,000 or a cash flow of 40,000 for the next 8 years. And the question says you should calculate what? The value in use. Please note that you can only estimate for only what? 5 years and not more than 5 years. Please, any question? Any question? All right. Can you hear me, please?
Yes, sir.
All right.
Yes,
okay. So you don't what? Estimate more than what? 5 years. Estimate more than what? 5 years. So under impairment, we don't have what we call impairment gain or impairment loss. No. So in a situation where we said that impairment happened if what? The carrying amount is greater than the recoverable amount. So if I have PPE, then I have the carrying amount to be 4,000. Then carrying amount 4,000. Then I have net realizable value. That is the fair value less cost to sell. Let's say I'm having it to be 6,000. Then value in use is equal to 6,200. What will be our recoverable amount? What will be our recoverable amount? We said the recoverable amount is the higher of what?
Value in use.
The fair value less cost to sell, and then what? The value in use. So we are going to pick the higher one. So once you pick the 6,200, that becomes the recoverable amount. If you choose the higher one here, it will not be called value in use, or it will not be called net realizable value, but it will be called what? Value in use. Value in use. So it is this amount that we are going to compare. So has the asset impaired? Has the asset impaired?
No.
Yes.
No,
So
sir.
when the asset when there is no impairment, when you test the asset and there is no impairment, what do? You do nothing. But where there is impairment, how do we recognize impairment? How do we recognize impairment? Yes, who can help us? How do we treat impairment? So, yes, anybody on the floor? Oh, okay. So,
Please, what's the question? The question.
No, I am saying that how do we recognize an impairment loss? How do we recognize impairment loss? That was the question. It's not any calculation or anything.
Sir, hello.
Yes, sir.
Yes, please, the impairment loss will be charged against the profit and loss. Then in the balance sheet, it will be deducted from the PP.
Okay, that is an attempt. So, what the answer given by our brother?
So in the profit and loss, it will be an expense.
Yeah. Okay. So the answer provided by our brother is only correct if it is what? A first time revaluation, a first time what? Impairment loss. If the asset had any previous revaluation gain in that asset, in respect of that asset, then the impairment loss will go and what? Reduce whatever gain that is in the what? In the that asset account. But in a situation where there is no revaluation upwards in respect of that asset, then it will be what? Recognized in the P&L directly. So the recognition of impairment loss is one. If the asset already has any revaluation surplus in respect of that asset, then the impairment should go and reduce that amount in other comprehensive income. Any excess of that amount should be recognized in what? The profit or loss account. So the profit or loss account is just serving as a suspense account for the impairment. Subsequently, if the asset has gained, if there is any reversal of impairment, then we have to go and reverse the earlier impairment that was what? Done. So we'll come to reversal of impairment shortly. In reversal of impairment shortly. Okay, so let us take some 1 minute to give what can cause an impairment in an asset. Sources. Sources of what? Sources of information that will suggest that an asset is impaired. It can be internal and what? External. So what are the sources of the sources of impairment?
Wear and tear.
Okay. Somebody is saying that an asset can be impaired. The causes. An asset can be impaired where there is what? Wear and tear. Yes. When an asset is being damaged.
When the market price reduces.
When the market price of this asset sadly reduces. It can also result in what? Legislation. Let's say that the government of Ghana has passed a law that there shouldn't be any production of so and so material, so and so goods. And that goods is produced by a certain machine in your what? Warehouse. So it can also be caused by what? Legislation. Yes, what again?
Non-existence of market. Non-existent market of the asset.
Markets?
Non-existence, meaning that there is no market existing for the assets.
Okay. Okay.
Yeah.
When it is very difficult to sell the asset, that's what is right. Okay. Yes. Yes.
A change in consumer demand.
The change in consumer demand. Change in consumer demand. Change in what? Consumer demand. So those are the possible causes. So we are saying if the asset is being damaged, let's say all of a sudden there is recently, is it Accra Girls or which of the schools? Which of the schools?
Laboni.
Oh, Laboni. Thank you. Laboni. So if that happened to be a warehouse, and then the plant or the inventories in that warehouse got burned, then virtually even the building itself, the building integrity is now. So if you want to value that building now, that building would what? Value will fall because of what? The outbreak of what? The fire. The outbreak of the fire. So those are some of the impairments, the issues that would happen before we say that there is some evidence of impairment of that asset. All right. So that is that. That is that. So we are saying that all assets must be reviewed at the end of what? Each reporting year. The reporting year is what? The date of the financial statement. Each reporting year we have to what? We have to review all assets to test whether there is what? Impairment. So I was saying that there may be instances where there may be a reversal of the impairment. So please take note that an impairment attributable to goodwill cannot be reversed. It can never be reversed for goodwill. Why? Because anytime we said there is a reversal for goodwill, we don't recognize internal goodwill. So anytime there is a reversal, we don't attribute it to what? We don't attribute it to goodwill, simply because when the appreciation in value comes, we attribute it to what? Internal generated goodwill. And internal generated goodwill cannot be recognized in the what? In the books of the entity. Why? Because it cannot be separated from the business, or it is not. It cannot be capable of being sold separately. All right. So far we've learned about the definition of impairment. causes of impairment, the scope. We also said the discount rate to use. We also talked about how to discount the future value to present value. How to discount the future value to present value. All right. So on that note, let us see and take some few questions and let us see. Example number one. Example number one. We are talking about impairment. We are talking about impairment. You know, there is a thin line between the IFRS and then the IFRS. And in this case, for this impairment, there is no much changes. So if you are doing PSA or FR, you need these two knowledges in order to propel your chances of passing. All right. So we have example number one on the board, and we are to determine the recoverable amounts and determine impairment, if any. If any. So we have the assets. We have the assets. The assets are A, B, and C. We are talking about the carrying value, your CV. Your CV, carrying value, it can be CA, carrying amount, is the same thing. Here is 100, here 150, here 120. Then we have net realizable value, means that the fair value less cost to sell. That's the net realizable value, 110. We have 125. We have 100. Then we have the value in use. The value in use are 120, 130, and then what? 90. So our A is saying that we should determine the recoverable amount. Recoverable amount. We have A, B, and C. So what will be our recoverable amount? Recoverable amount. We are looking at the higher.
So for A is 120.
So A will be 120.
The A will be 120. Why 120? It is because between the net realizable value and the value in use, 120 is higher than what? 110. So we are picking the higher of the two values. When you pick the higher, it becomes what? A recoverable amount. You will not say that that is our value in use. No. What of number B?
B will be 130.
130. And then C will be what?
It will be 100.
100.
Is
B, determination of what? Impairment. Please, are we all following?
Yes, sir.
Determination of impairment. We have A, B, C. Impairment. Impairment. So we have our carrying amount. So bring your carrying amounts. A, 100. B, 150. C, 120. So these are the carrying amounts from the question. Then from what we obtain from A, determine your recoverable amount. Recoverable. The recoverable amount, we said 120. Here will be 130, and here will be what? Then we'll bring what we call impairment. So what will be the impairment under A?
It's nil. Zero.
It's nil.
Okay.
Zero.
So there is no impairment here. Why? Because the recoverable amount is more than what? The carrying amount.
Carrying amount.
Good.
Yeah.
So if you can, what you can obtain from the use of the assets or through sale, the hire is more than what the asset is stated in your financial statement, you do nothing. We don't have impairment gain, but we have what? Impairment loss. Number 2, B. What will be our impairment, if any? What did we say about impairment? We said that there is always impairment if the carrying amount is more
And
than the recoverable amount.
recoverable amount.
So here, what can we say?
Impairment of 20.
Impairment of what? 20.
20.
Because the recoverable amount of the asset B is less than the carrying amount by what? 20. Okay, let me just chip in this. You see, what did we say is impairment? We said impairment is the amount at which the carrying amount of an asset is more than the recoverable amount, or where the recoverable amount is less than what? The carrying amount. All right. I went for an interview in the public sector. And you know, there is sometimes some of the persons who are interviewing you are not accounting inclined. So they gave them a marking scheme. What is this? And then the answer. So I went and a question with they asked a question concerning impairment. And what was on his marking scheme was that an impairment is the amount at which the carrying amount of the of an asset is more than the recoverable amount. And I was asked, have you heard about impairment? I said, yes. What standard regulates that? I said, IAS 36. Then they said, good. So what is impairment? And I said that impairment is the amount at which the recoverable amount of an asset is less than the carrying amount. And the person said, that's not there. Simply because on his marking scheme, the impairment was written as the value at which what? The carrying amount is more than what? The recoverable amount. And I said that it is the amount at which the recoverable amount is less than what? The carrying amount. And he said I was wrong. And I said that no. It cannot be what? It cannot be wrong. It cannot be wrong. So, in fact, so those were the preliminary questions before the finance deputy director of finance came in. And the issue of impairment came. And I gave out the definition and the man started laughing and said, it's perfect. It's perfect. So, so the man was saying that, oh, okay, if there is another way, then he doesn't know. So on his script, this is what is given. So please, you should know the two dynamics, whether the carrying amount is more than what? The recoverable amount, or the recoverable amount is what? Less than the carrying amount. And we settled on that one. But at the end of the day, I proved my point that that is also what correct. So when he said that that was not correct, then I used the second one, that this and that, and I was telling him that it is the same thing, but he was finding it difficult to understand that means the two are the same. All right. So let's come to asset C. What is there? So what will be our impairment for asset C?
10.
Asset C
20.
will give us what? Is
20.
it 20 or 10?
20.
20.
20.
All right. 20. 20. Okay, so now you are a nursing, you are a baby. So you started breastfeeding. So this is just the preliminary. Let's go deeper and see what will happen. All right, let's take, please, any question on this? All right, if there's no question, then let's go to exam illustration number 2. Exercise number 2. Exercise 2. Exercise 2 said that on 1st April 2020, S&D purchased an equipment at a cost of what? 100,000. Cost 100,000. And this asset is being depreciated at 20% per annum on straight line. So 20% per annum on straight line, 100, 20% straight line is the same as 100 divided by what? 20, which will give us what? 5 years. Am I correct?
Yes, sir.
Yes. 20% what? Per annum, straight line basis. On 31st December 2021, the recoverable amount of this equipment is estimated as 58,000. So we are to determine the impairment loss if what? Any. So we have been given the cost of the assets. We have been given the depreciation method. Now, what do you need to do? We were given the recoverable amount on a certain date called 31st.
Hello, sir.
On a certain date called 31st December 2021. That is what? 1 year after. So what we have to do? We have to determine the carrying amount of this asset on that date. Mind you, the first one, they gave us the carrying amount, they gave us the fair value less cost to sell, they gave us the value in use, and we are able to determine what. So now let us determine the carrying amount and compare it with the recoverable amount. So this is how what you need to do. All right. So this is the costs on 1st January 20. So we need to charge our what? Depreciation. The depreciation here is what? 20%, which will be the 100,000 divided by what? 5 years, or 20%. How much would that be? I can find my calculator.
Sorry, sir.
20,000.
Sorry, sir. So the date is 1st April 2020. 1st April.
1st April.
April, yes.
1st April
2020.
Yes. 1st April 2020 to 31st December 2021. How many months? So you count your figures. We in this
9 months.
We were told this thing in primary what? January, February, March, April, May, June, July, August, September. Please, this is the time that you need it. When they were telling you, you were saying that, oh, this thing these are for the kids. So now you start to count your figure from April, May, June, July, August, September, November, December. So now, how many months to the 2020?
9 months.
So this one times what? 9 over what? 12. This one will give us how much?
15,000.
15,000.
15,000.
Yes, sir.
Sir.
So what will be the carrying amount as at 31st December
85,000.
2020? That is what?
85,000. 85,000.
85,000.
1, 2, 3. When was the recoverable amount given? December 2020. So we need to charge the depreciation. December 2021. We need to charge the depreciation for 21. So depreciation. That will be the what? 100,000 over what? 5 years. That will give us how?
20,000.
This will give us what?
20,000.
Yes. So what will be the carrying amount as at 31st December 2021?
65,000.
65,000. So this is the carrying amount on the date that the recoverable amount was given. Anytime the recoverable amount is given to you on a specified date, please calculate the carrying amount as at that date. Please, any question on this before we move on? All right. So we have ascertained the carrying amount as at 31st December 2021. Now let us compare it with our what? Recoverable amount. What is our recoverable amount? 58. 1, 2, 3. So, is there any impairment?
Impairment of 7,000.
Impairment of what? 7,000.
7,000.
Because the carrying amount as at 31st December 2021 is more than the recoverable amount as at 31st December 2021 by what? 7,000. Please, any question?
Sir, please go over the 5 years, how we had the 5 years.
Oh, if the 5 years is confusing, 20% per annum. 20% per annum. So here, each year is 20%. Each year is what? 20%. Times what? 20% times 9 over 12. Times what? 9 over 12. Master, are you okay now?
Yes, please. Yes, please.
Yes.
Thank you so much.
Okay. Please, any other question?
Please, my question is, what of if, let's say for the first calculation where we had 100,000 divided by the 5 years times the 9 over 12. Let's assume the whole thing started from January and then ended on the December 31st. and the second one to also started from January the following year and it ended at 31st December. Can we calculate for the first one so I will get the annual depreciation, and then for the second one we just multiply the annual by the years or the 2 years, since they all started from January and ended at 31st December?
Yes, you can do it like that. But the danger there is that you can do it like that. But the question will tell you that you should prepare the financial statement extract. Please, 1 minute. Senior, please come again with your question. So, what he was, hello, can you hear me?
Yes, sir.
Yes, sir.
Yes, his question was that if it were to be a full year depreciation, what do you do? When it's a full year depreciation, you don't do what? You don't prorate it. In the same way, you can do it the straight away method. But when the question says that you should calculate the impairments where or, okay, by that method, this is how it's going to be. We were having a cost of what? A cost of 100,000. So let us now calculate from April to December 2020. How many months? 9 months. Then from January to December 2021, that is what? 1 year. Is that not it? Senior, is that not it?
Yes, sir.
Okay. So when you say 9 divided by 12, that will give you what? 0.75. Am I correct?
Yes, sir.
Good. So we want to determine the current amount as at that date. Then we said that we are going to charge the depreciation. And this depreciation should be what? The accumulated depreciation. That will be 100,000 times 20%. Times what? 20%. 100,000 times 20% times what? 1.75 years. Please, that will give us what is that accumulated depreciation? Accumulated depreciation. 100, 1, 2, 3 times 20%. This one multiplied by 1.75 years.
35,000.
Is it what? 35,000.
35,000. Yeah.
Yes.
So what will be the carrying amount?
65,000.
65,000. It will give you the same amount. Then you bring your recoverable amount of what? 58, 1, 2, 3. And the impairment will still be what? 7,000.
Thank you, sir.
Okay. But the danger here is that when the question says that prepare the financial statement extract, how will you prepare? Because we need the depreciation for 2021. So you see here, the depreciation here, all is the accumulated depreciation. When you go to the first method, you'll see that the depreciation here, we have the depreciation charge for 2020. We have the depreciation charge for what? 2021. So if you are to present the financial statement extract, then you say depreciation for 2021, 20,000. Impairment, 7,000. So any of them will give you a correct answer. Please, any question? All right, so let's hurry up and do some 2 other examples, and then we can close for today and meet on Thursday. All right, so we said something that the discount rate to use in respect of an impairment should be what? The pre-tax rate. Now, S&D acquired an equipment on 1st March 2017. The following cash flow expected to be derived from the asset are as follows. We have the year, the pre-tax cash flow, and then what? The post-tax cash flow. Now we're giving the cash flows. So which one are we going to use?
The
Pre-tax cash flow.
So we are going to use the pre-tax cash flow against what? The pre-tax discount rate.
Discount rate.
The pre-tax discount rate for this plan is what? 8, and then the post-tax is what? 6. Calculate the what? The value in use of the plant. We are to calculate the value in use of what? The plant. All right. Value in use of what? The plant. Value in use. Please, public sector financial reporting, the July date is here with us, and you may have an impairment question. So please make sure you study and then master your impairment very well. If you are doing financial reporting, master it very well. If you are doing public sector, you need to also do it what? Same. All right. So let us move on. Let us move on. All right. So we have the year. Illustration number 3. Illustration number 3. We have year. We have cash flow. We have the discount factor. Then we'll have our present value. So here we have 2018, 2019, 2020, 2021, and then what? 2022. I told you that it shouldn't be more than what? 5 years. This is 1, 2, 3, 4, 5. So in 2017, we are estimating the amount that will be derived from this asset from 2018 onwards, future, into the future. So we need the value in 2017. So we are going to discount that future value to what? Present value, using the present value formula. So the pre-tax rates are 16. Here is what? 14. Here is 10,000. Here is what? 6,000. Here is what? 20 what? 6,000. Please take note. Anytime you have the question like this, and the question says that this equipment will be sold at the end of the 5th year, and then the question comes with what? The salvage value or the scrap value. Please add the scrap value to the cash flow. I repeat, where the asset after the end of their 5 years, that asset will be sold. and that sales amount in the form of what? Scrap value or salvage value is given. Add it to what? The cash flow. Assuming the question says that at the end of the year, this equipment can be sold for scrap for how much? 10,000. Then we need to add the 10,000 to the 26,000. Please, are we all on the same page?
Yes, sir.
All right. So let us now apply our present value. Present value. So we are going to find what? 1 over 1 plus r raised to the power what? N. Or 1 plus r raised to the power negative n, where r means the discount rate. And then the n means the number of what? Years. So let us now do it. So here, we are going to do 1 over 1 plus 0.08 raised to the power 1. 1 over 1.08 raised to the power 2. Then you do it for all of them. So what do you get for the first year?
First one, we have 0.9259. 9259.
Please, are we all getting the same thing?
4 decimal places.
Oh, let's do it 3 decimal places, please.
Okay. Then 0.926.
0.926. So what are you using? Okay. So here will be what? 0.926. Yes. The second one, year 2.
0.857.
0.857. Yes. In the third year,
0.794.
794.
Yes.
The fourth year,
0.735.
0.735. Please, are we all getting the figures? Or do you know how these figures were arrived?
Yes, sir, we are following.
Okay, so the fifth one will be what?
0.681.
All right, so we have discount these future value toward present value. So now we multiply the discount factor, the cash flow by
another easy way to also get the discount factors is when you get a first figure, you just divide it by the 1.08 for the second year. Then you do it like that. So the third year, you divide by 1.08, you get a figure.
If you do what?
I'm saying that another easy way to get your discount factors. So for instance, the first year,
yes,
you should do 1 over 1.08.
Yes.
Okay, so when you get the figure, when you get the answer, the second year, we divide it by 1.08.
As in which answer?
The second year.
The second year.
The discount factor.
The discount factor. This please someone should confirm.
Yes, confirmed.
Yes, confirmed.
Confirmed. So that one is on the basis that your first one is correct. Is that not the case?
Yes, sir.
Yes.
But the second one.
So the first one, when you get the answer, so when you do 1 over 1.08, the answer you get, if it's correct, then the second year, we divide your answer by 1.08.
For the second one, yes.
Yes. Then the
Yes.
third year you do
You
same.
do
The
it
answer
for the second year in that order.
Yes, in that order.
Yes.
So all the answers that you get, you divide by 1.08.
08, 1.08, 1.08.
Yes.
But we are saying that you can use that method only if your first one is correct. Oh, if the first
Yes,
one
sir.
is wrong here, then
Yes.
in the bush.
Yes.
So please, let's be careful using the
Sure.
shortcut. All right. So what will be the present value? What will be the present value? 16,000 times 0.96.
It's 14,816.
14,000.
Yeah. 816.
Okay. So I'm not having calculator here. So let's go. Once the understanding is there, then year 2, 2019, 14,000 times 0.857.
11,998.
11,998. Yes, year 3. That will be 7,000. This is 10,000, 0.94. That will be 7,944.
Yes.
Yes. Then the next one, 6,000 by 0.735.
It's 4,410.
4410.
4410.
4,410.
Okay. Then 2022.
17,706.
17,706. So when you are done, you add the all from head to toe. So this will give us our NPV, net present what? Value. So this net present value becomes our what? Value in what? Use. Yeah, so what is the amount?
56,870.
Please, one by one. 56, yes.
870.
870. So this is the recoverable amount. This is the value in use. So what have we learned? We have learned how to calculate the carrying amount when not given. We have also learned how to calculate the value in use when not given. But the fair value less cost to sell there, they will tell you that if the asset is being sold, it can be sold at what? 5,000. However, a cost of 4,000 will be required, will be required in order to realize the sale. So that one, it is not anything difficult that you cannot what determine. Please, any question? Okay, so let's end by illustration number 4, so that when we meet next time, we'll talk about, yes, sir.
Please, concerning the scrap value you said,
yes,
that
sir.
At the end of the year, when there is a scrap value, you need to add it.
Yes.
I want to ask that with the current example we just did, the illustration number 3.
Yes,
you
sir.
see that for the 2022, the cash flow was 26,000, and then we had a discount factor of 0.681.
Yes,
I want to ask that, is it that we have to add the scrap value to the last figure, that is the 26,000?
Yes, you have to add it to the cash flow,
before we discount it.
Yes,
before we
please.
multiply with the discount factor.
Yes.
Okay.
So you always add the scrap value to the cash flow before you discount.
Okay.
And that is evidence.
I thought after doing all that, we have gotten our value in use, then we add the...
No, sir. We need to discount.
So it means we are adding it to the last year.
Yes.
Cash flow.
Yes.
Before we discount.
Yes. The year in which that asset can be sold with that amount, add it to that year. add it to that year. Not necessarily.
Then you multiply it by the discount factor.
Yes.
Okay.
So with that,
Thank you.
Let's end it with this illustration, and this illustration would show you something. This is ICAG financial reporting, November 2010. November 2010. So it said that Guaso Timber Limited, GTL, produces and exports lumber and planks. It owns a plant which has a book value of 1.8 million as at 1st January 2010. The government of Ghana passes a legislation that restricts the exportation of lumber. Consequently, so when we were discussing the causes of impairment, we said that legislation can be passed. So here, government has enacted a legislation that will restrict the exportation of these products. Then they said that consequently, GTL has to reduce production capacity by what? 40%. This is an indication of what? Impairment. Cash flow forecast for the next 5 years included in the budget submitted for management approval in January 2010 shows the following. So we have the amounts. We have those amount there, 552, 506, 376, 250, and then the additional information. The cash flow forecast for 2014 includes expected proceeds of 60,000 from disposal of the plant. What do we do to this 60,000?
We add it.
We add it to the last year.
Please read it again. They said that the cash
already included.
It is already included. So it is up to you to know whether to include it or not.
Okay.
It is up to you to know. So what did I say about a scrap value or a salvage value? What did I say? I said we should add it to the year in which it will be what? Scrap or it will be sold. Is that not the case?
Yes, sir.
This question is saying that the 2014 one includes 60,000 that will be realized from the disposal of the asset at the end of its useful life. And the amount involved there is what? 60,000, and it is included in the cash flow. So the question now is, are we to maintain it or we are to take it away? We are to maintain the figure because we learned that anytime the asset is going to be scrapped at a scrap value or a salvage value, the amount of disposal should be added to the cash flow. And this question says that it is included in the cash flow, meaning that the cash flow was how much? 500,000, and the disposal amount is what? 60,000, making the 560. Therefore, we are going to maintain the 560,000. Are we okay? Are we all okay?
Yes,
all
yes,
right.
Sir.
Yes, sir. Please move on.
Okay. So they said that it is estimated that if the plant is sold in 2010, it would realize a net proceed of 1,320,000. The cost of capital for GBL is 15%, ignoring any inflationary effect. So look at this. We have been given the whole thing there. So we need to we need to calculate. We need to calculate the value in use and compare it with the fair value less cost to sell to select the recoverable amount. And finally, we compare it with the current amount of what? 1.8 million. This question came for what? 5 marks. 5 marks. So at this point in time, everybody here can do something. Example number 4. This is our last question. So we have the year 2010. So we have our cash flow. Cash flow 550. 1, 2, 3. I told you that if depreciation is deducted, you add back what? Depreciation, because depreciation is not what? A cash flow what? Item. It is an accounting measure. Discount factor or the discount rate is what? 15%. 15%. Then we have our present value. So let's so what will be the 15% for year one? Will give us how much? 15% year one.
Hello, sir. The
Yes,
cash
sir.
flow is
The cash flow
552,000.
is
Oh,
550.
sorry.
550.
Okay, sorry. Okay, so what is the discount factor? 0.3 decimal places. 0. What? We are still using that 1/1 plus r raised to the power n. 2010 will be what? Year one. 2011, 2, 12, 3, 2013, 4, 2015, 2014, 5. So year one is how much?
0.870.
0.870.
Okay, so 0.870 multiplied by 552,000.
$480,240.
So let's go to year two. The year two, the cash flow is what? 506,123. Then the discount factor will be 0. What? It always reduces. Here will be 0.7 something.
756.
0.756 multiplied by 506,000.
That's 8,253.
38, 2,
5.
5,
382,536.
Okay. So 2012, we had 376. Here will be 6 something.
0.658.
658. So multiply it by the 376.
$247,408.
Is that what? 247?
247,408.
Okay, let's go to 2013, the last 2 years. 2013, and amount is 250,000.
$0.572. 572.
0.8.
572.
So, and that will give us how much?
143,000.
143,000 flat.
Yes, sir.
Okay, so the final one. $2014.
0.497. The discount factor.
The discount, sorry.
Discount factor is 0.497.
Discount factor is, I'm coming, 1 minute. Let me. So we have 2014. 2014, what was the cash flow?
560,000.
Okay. Hey, this saving. Okay, so 2014 is what, 560?
Yes.
And then the discount factor was how much?
0.497.
So the first one was what? 0. What?
570.
Okay, 0.572. Okay, yes. So the last one is how much?
278 320.
Okay, so we add from the head, from the top to the down. Yes, what is the final answer? From the top to the down.
It's 1531504. 31504.
504. So this is the value in use. Then we have, they gave us what? Net realizable value to be what? 1,320,123. So what is our recoverable amount? Our recoverable amount will be the higher of the two figure, which will be 1,531,504. And we compare it with our what? Carrying amount. The carrying amount from the question was how much? 1,800,123. So what is the impairment, if any? What is the impairment figure?
$268,496.
So how are we going to recognize these amounts? This is the impairment loss. So we are going to debit profits or loss with 268,496 and credit the what? The assets, which is called plant. With the same what? 268,496. Any question? This is the end of the day.
Hello, sir.
Yes, sir, senior.
So, sir, the 40% in the question, does it have to do anything to do with the with
So
what
the
is done?
40% in the question is the indication of impairment. This asset was operating for a certain what? Capacity. And they said that that capacity needs to be reduced by what? 40%. That is what? Indication of impairment. We've read the first one. The indication of impairment, somebody said when the asset value go down drastically. I also mentioned government legislation. Somebody too was saying that when there is change in consumer taste and preferences. So this 40% is an indication of what? Impairment, senior.
Okay. So in the question, it will not have any impact?
No,
on the
not at
solution?
all. Not at all. It is just telling you that as a result of that legislation, it has caused an impairment. What is the causes of that? The cause of that is that because of that legislation, production of that product will be reduced by what? 40%. Indication of impairment. So you are not going to use that one for anything. All right.
Thank you.
Any
Hello,
questions?
sir.
Yes, sir.
Yeah, please, I have two questions. One is a follow-up to the first, to my
Okay,
colleague's
senior, go ahead, boss.
Yeah, so does that mean that the cash flows that were provided, the budgeted cash flows, were
Yes.
actually based on the new production capacity of the
Exactly.
assets?
Yes. Based on the 40% capacity.
Okay.
Yes.
And the second question, it seems the date for this question was 1st January 2010, and we discounted the projected cash flows to this date.
So the cash flows are at the end of each year. So from 1st January 2010 to 31st December 2010 is 1 year. Time value of money and then the discounting.
Sure. So in real life, if the accountant needs to report the impairment at the end of the year, and this needs to be estimated, how would they change it in the date after
you said if the accountant is to do what?
If the financial year ends, let's say ends on 31st December each year.
Yes.
And you are to now get the impairment.
So if it is at the end of the year, then we need to estimate. So these cash flows are based on the future values. So if you are to determine the value in use, then on that day, the question will give you the future values in respect of that date.
Okay. I get it. Thank you.
Any other? Yes, senior.
Please, I understand. If I understand properly, the reason we are discounting even the first one, which is the 2010 one, is because the figure given is as at the end of the year, and the question is as at the beginning of the year.
Exactly so, senior.
Okay, because initially I was thinking since they are all in 2010, the first one wouldn't be discounted and it will start from 2011.
Yeah, so this one, the cash flow are at the end of the year.
Okay.
The cash flows are at the end of the year.
Thank you very much.
Okay. So please, any further question?
Hello, sir.
Yes, sir, senior.
Yeah, I stood up small. How did we get the recovering amount?
So we got the recoverable amounts by discounting the future values to what? Present value. This is what we have on the board.
Okay.
Yes. So the total of the present value, which gave us what? The net present value or the value in use. Then we'll compare it with the net realizable value and pick the higher one. And we picked the higher one, which is what? The value in use. And I always told you that in most cases, 99%, the value in use will be more than the net realizable value. So you compare that one with what? The carrying amount. And if the carrying amount is more than the recoverable amount, there becomes the impairment.
So please, last one.
Okay.
What's the rationale for picking the higher amount?
What is the rationale for picking the higher amount?
To be the recoverable amount.
Yes. Yes, that is the question. Anybody to answer?
Closer.
Yes.
Yeah, that is what that is the principle
That's what the standard is. That's what the standard is.
That is the standard principle that the higher of the two is used against the carrying amount.
Okay. So the senior man said that is what the standard says. Yes, it is true. However, these amounts are all what? Estimates. So it is subject to what? Plus or minus error, some percentage of error. So it is a probability. So in case of that, it is an estimate. So in order to be at the safer side, you do what? You choose the probability of what? The highest what? Outcome. So based on that, the standard says that you have to pick what? The higher. You have to pick what? The higher of what? The two values. So the probability of them occurring will be either this or that. But in this case, they are all estimates which are subject to margin of error. Here, then you have to what? Pick the higher one to be at the what? Safer side. So that is what the standard says, that you always pick the higher one.
Okay, sir. Thank you. But in fact, I was thinking maybe by prudence concept. Now we are interested in the impairment loss. And by picking the higher amount, what it means that our impairment loss is going to reduce comparatively.
We are picking
what I'm saying is, by picking the higher amount, now we compare the 1531 against the 180, and we are getting 268 as our impairment loss. If we had picked the 1320.
So if you want to bring the idea of prudence, then we should have even taken the lower amount.
Exactly.
What does prudence says? The prudence says that you have to be quick to recognize losses, but when we come to gains and losses, you should have some kind of what realization. You have to relax. So if you are bringing the concept of prudence here, then it means that we have to pick the higher, the what, the lower amount.
Lower to be safe, yeah.
So that is not a prudence concept here.
Okay.
All right.
Thank you.
Okay. So if there is no further question, yes, sir.
There's a question.
Okay, boss.
Sir, please, with the extract, the income statement. So after we have gotten loss, does it mean that we are debiting the profit or loss account either reduce?
So debiting the profit and loss account means that you are reducing profits. You are recognizing it as an expense. An asset has what? A debit balance by default. Crediting the assets account means that you are reducing the asset figure by that amount.
All right, sure. So it means you record it in the profit and loss account in the name of expense.
Yes. Like how I said, you debit P&L in the name of what? Impairment loss, and credit the assets. So crediting the assets means that you are going to what? So if you want to prepare the profit or loss extract, profit or loss, P&L extract, who have our what? Impairment. Impairment of what? 268,4 like this. Then if you come to the statement of financial position, we'll come to what? Plant. So the plant will be 1,800,123 against what? 268,496. So what would be the amount? What would be the amount?
Yes.
15 something or
153.
Yes.
1531504.
So who can tell me what has happened?
I'm having class online. Zoom.
Who can tell me that what has happened? So it means that you are restoring it to its what?
The present value.
You are returning it to its what? Recoverable amount. It's recoverable amount. That's all. Yeah. Okay. So the next time that we meet, we are sir.
Please, I want to ask a question, but I want to can you show the question so that I can ask?
All right, senior.
Please say the cash flow forecast for 2014 indicate expected proceed. So in case the expected proceed is in brackets, how will you treat that one?
No, the expected proceed cannot be in a bracket. The only one that can be in the bracket will be the net realizable value. They will tell you that the net realizable value is for 132 so and so. Then they put into bracket less cost to sell of so and so. It means that that amount has been what deducted already from the proceed. But if the question says that if the assets will be sold in 1st January 2020, the fair value is 1,320,000. The cost associated to realize this sale is 40,000. Then you need to calculate the fair value less cost to sell to get the net realizable value. 1,320 minus the direct cost to sell. Okay. So yes.
The last one. So we know that with impairment, it is when the carrying amount is either is greater than the recoverable amount, or when the recoverable amount is less than the carry amount.
Exactly.
I want to ask that. So with impairment, when do we consider impairment? When do we say that we have to consider impairment? Like, what are the instances that we have to consider impairment?
So I indicated that at the end of each reporting year, you have to conduct impairment test. Assuming there is no indication of impairment, you have to conduct impairment test at the end of each reporting year. But where there is an indication of impairment, then impairment review is necessitated. For example, I made mention of this Laboni Senior High. Assuming it's a warehouse and it got bent like that, that is an indication of impairment. And impairment review is very necessary at that moment. You don't wait till the end of the financial year.
Thank you so much, please.
Right. So we learned the indication of impairment, discount rates, and others. So the next time that we will meet, we'll look at reversal of impairment as well as how to allocate impairment for a cash generating unit. So this is S&D Professional Institute. We run ICAG courses for level 2 and 3 only. All courses in level 2 and level 3 only. So please, this is just a preparatory note for you to be lacing your shoes before the main classes start from the 7th of April 2025. Assuming you want a place, a tuition center that you wish to register with for your ICAG July 2025 diet, S&D is the best place to be. Our numbers are on the slide. So please, our doors are open and you can reach out to us at any time. Thank you. So we'll meet. The next meeting will be on Thursday. That will be for IPSAS. And then the subsequent one will conclude this impairment. Thank you.
Thank you, sir.
Thank you, sir.
All right.
Thank you very much.
So, thank you.